Welcome to Edison Open House. I'm Rachel Carroll, President and Managing Partner. Delighted to be having coffee today with Jack Terranova, an Executive Director in Oppenheimer's Healthcare Investment Banking Group. It's one of the larger healthcare teams on Wall Street with 160 stocks under coverage and 11 healthcare analysts. Jack has direct experience in over 100 transactions, raising nearly $2 billion for life sciences companies. Jack, an impressive resume. Welcome.
No, thank you very much, Rachel. It's a pleasure to be here with you today. I think it's been a very interesting year in the U.S. capital markets, and this event that Edison is putting on is very timely. So looking forward to the discussion here.
Great, thank you. Well, as you say, looking back on last year, it was an incredible year for healthcare investing. You had a wide open IPO, SPAC, follow-on market, a robust M&A environment. Could you talk about some of the trends that you saw as an investment banker?
Yeah, sure thing. So the pandemic was front and center in 2020. I think when it first hit in the beginning of the year, we began to see capital almost across the board cycle out of major sectors like energy, retail, consumer, et cetera, and into life sciences. And it's become clear that investors are looking at the healthcare sector more broadly with a great deal of hope and optimism as the industry has really pulled together to develop some new therapeutics and diagnostics to address the COVID crisis. And we've already seen, as you know, 2 vaccines that have come to market using the novel mRNA technology. So I think these dynamics have drawn generalist investors and retail investors to the space. And that's what's really led to this robust IPO activity, capital markets activity more broadly, and a steady stream of M&A. At the same time, we have to remember, even pre-pandemic, there's been a tremendous amount of progress and momentum in the life sciences sector over the last few years. Emerging technologies that are really driving advancements. So the underlying fundamentals of the industry are sound. I think the race to develop a cure, a vaccine, has really just further accelerated investor interest in the space.
Great, thank you. So underlying fundamentals are sound. So you're not anticipating a sharp correction as we head into 2021?
No, I mean, looking to 2021, it's hard to say if returns will be sustainable through the whole year. I think we feel optimistic that at least the financing markets will remain open and M&A will remain robust in the first half of the year. I stopped short of making any predictions for the second half. We have a new administration here. Only time will tell how the market reacts to some of the new policies and pronouncements. And we expect in the first 100 days, it'll be relatively quiet. The initial focus will be on Obamacare and rebuilding that, right? So some of the questions we're asking towards the latter half are, will the goodwill that the industry has gained over the last year persist in a post-pandemic world? And will talks of price controls and tightening reimbursement return? So these are some of the things that we've seen put pressure on the industry in the past. So as we look for these dynamics in the market, we'll be certainly monitoring and ready to adapt as we go into 2021.
So a lot of the returns were obviously driven by infectious diseases and diagnostics. But what were some of the other therapeutic spaces that caught your attention?
Yeah, so it's not surprising that in the pandemic environment, we saw infectious diseases and diagnostic plays lead, and there were very strong, subsector returns there in 2020. Outside of those, the oncology sector outperformed, driven by strong data, some high-profile acquisitions, and we've seen incredible progress in the oncology space more generally, with the emergence of an expansion of technologies like immunotherapy, cell therapy that are addressing very big markets and have become mainstream. Gene therapy also outperformed. We've seen some of the most cutting edge technologies in that space kind of go from the lab to public ready story very rapidly. So I think that's another one to keep an eye on. On the downside, there wasn't much in the life sciences industry that didn't outperform the broader markets, but we saw the liver disease space lag a little bit, continuing a downward trend that started in late 2019. And then the women's health plays struggled due to some disappointing product launches and BD deals that fell through at the beginning of the year.
Thank you. And you're obviously based in the US and focused on the US IPO market. So it's the first time in 10 years, no life sciences IPOs priced below the range, and in fact, a third priced above the range. So what are some of the other dynamics you're seeing in the US market?
Yeah, so I think that statistic is incredible. Life sciences companies have been able to file for IPOs with great confidence that the transactions will get done at the price at which they file. Some other trends we've seen: the median IPO size in 2020 was right around 175 million, which is more than double from 2019. Median pre-money valuations were about 450 million, so that's up almost 40% from 2019. And what this tells us is not only are IPOs getting done at desirable pricing, but there's a valuation premium in this market, and investors are willing to put in more capital in the IPO to ensure the company has adequate runway to hit its milestones. We're seeing the same thing in the private markets. Life sciences IPOs as an asset class have also traded above the broader life sciences markets. So about 81% appreciation as a whole for life sciences IPOs. And lastly, we've seen life sciences companies IPOing at a much earlier stage. So many pre-proof of concept. There are 70 IPOs in the space. 15 were for preclinical companies, and there were many more for earlier clinical stage companies. So a lot of interesting trends, and we expect these to continue in the near future.
And you briefly touched upon the private space. What about the size of transactions in the private space and what you're seeing in terms of acceleration to crossover rounds? And it'd be useful within that if you have any context for US versus Europe.
Yeah, no, absolutely. So with the IPO markets, the crossover markets have been robust as well. So I think the same dynamic I mentioned of companies or investors rather putting in more capital versus less to ensure the companies have adequate runway to hit those milestones. We've seen that in the crossover market as well. And just a note on the crossover dynamic, US institutional investors have been funding companies privately earlier and earlier. So whereas we've seen the typical crossover round happen in the, call it C or D round, we're seeing Series A companies getting very large financings done and then having the ability to IPO, in 12 to 6 months after the transaction. So I think the active IPO market in part has been the result of an active crossover market.
Great. So Jack, let's talk about SPACs. So it was certainly one of the hottest investment trends in 2020. So could you explain what a SPAC is and why a life sciences company might choose a SPAC and not a more traditional IPO to go public?
Yeah, absolutely. And SPACs have emerged not only as a viable, but in some cases more desirable vehicle for some of these companies to go public. And what used to be an esoteric product is now kind of thrust into the mainstream. So on a high level, a SPAC is a special purpose acquisition company. That's what it stands for. It's a public acquisition vehicle that's formed by a management team to raise equity via an IPO with the intent of deploying that capital for a business combination. And the SPAC has a finite amount of time to make that acquisition. And SPACs across the board have been hot, but one interesting trend we've seen in the life sciences space has been that institutional investors have been sponsoring SPACs themselves and actually deploying their principals to serve as management of those SPACs. So these are investors that already have access to a lot of potential targets and can quickly identify kind of high quality companies to combine with. And some of the best performing SPACs with the highest quality companies have been a result of that approach. So with so many public ready companies in the market today and a very busy IPO calendar, the SPAC product offers some companies an alternative vehicle to go public with that's in some cases faster and less expensive, and with the same institutional backing as you would see in a traditional IPO. I think another important element here is how the market has perceived these alternative public offerings as a whole and how it's changed over the years. I think this rings true for reverse mergers as well. the perception went something like, if a company is using one of these alternative vehicles, it must mean they weren't able to get a regular way IPO done. Not the case in today's market. We've seen the investment community become very comfortable with these types of go public transactions. And again, it's more about if it's a public ready story, if the right people are involved, both from an investor and management standpoint, and the fundamentals are there. So the way we look at it is no solution is one size fits all, but as an executive at a company, it's wise to keep all options open.
That's great advice. And so it's faster, SPACs could be faster, less expensive, more institutional backing. I mean, in terms of looking at the more traditional IPO, I mean, a lot of the cost baked into a NASDAQ listing is in the ongoing compliance. So, how much less expensive is it really?
Yeah, so the traditional IPO process involves, engaging banks, lawyers, attorneys, and going through a months-long drafting process to prepare the prospectus. And it can get, lengthy and expensive, especially if you're getting, comments back from the SEC, et cetera. So, SPAC provides an opportunity for companies to take a different route versus doing the traditional process, and it can result in a less expensive go public transaction. That's not to say that the public company expenses will go away. Once you're a public company, those expenses persist. So really the time and cost savings are on the front end.
Okay, thank you. So let's shift gears and talk about the international market. So Oppenheimer, obviously very well established in the US. You've got 90 offices over here, but you've also got offices in Hong Kong, London, Geneva, Munich, a big operation in Israel with over 100 people on the ground. What are some of the opportunities you're seeing in these international markets?
Yeah, so we are an international firm. Outside of the US, we have, as you mentioned, significant operations in the UK, Europe, Asia Pacific. Israel, as you mentioned, is a very important market for us. We've had folks on the ground there for over 50 years. We have seen an increased investor interest in ex-US opportunities recently. I think in many cases, investors and frankly, we see an arbitrage opportunity for companies outside of the US. Same fundamentals apply when you're evaluating these opportunities, right, that we've talked about: solid management, differentiated technology, addressing an unmet need, sound regulatory strategy. But in many cases, you'll see that the comps tend to trade higher in the US. And the belief is that bringing some of these technologies to the US from ex-US markets can unlock some of that value for shareholders. It's also worth noting that it's much easier nowadays to vet international companies. I think our chat right now is a good demonstration of that. In a virtual world, investors and advisors alike can do Zoom meetings and can do most of their diligence virtually. So as the world gets smaller, we're seeing more and more cross-border activity and interest.
And it's interesting what you say about the arbitrage opportunity. At Edison, we've certainly seen an increase in US money inflows for both the public and the private space into more mature markets in Europe. So what does your typical corporate client look like?
Sure. So I wouldn't say we have a typical corporate client. We're very relationship driven, and we've worked with a wide range of clients from small to large cap and across industry verticals. We do have the resources to execute on a number of different strategies on an international scale. And it's really more about, what's the approach that's best for this specific client. So I think what we're real focused on is coming up with a tailored solution that'll create value for our clients and their shareholders.
Right. So Jack, pretend I'm a European company. I'm listed in my domestic market. I'm thinking about a NASDAQ listing down the line, but it's probably too early for me. What are some of the mechanics of selling to US investors?
Sure, no, it's a good question. So each market outside of the US has its own kind of specific mechanics, and we've executed in every major market in Europe. Financings are typically done as a private placement or a PIPE, right? If they're not done as a NASDAQ IPO, as you mentioned. And I think regardless of where the company is based, the path to a US IPO is the same. And we talked a little bit about the crossover market, but I think investors are more and more looking at investing in public ex-US companies in the same way that they might invest in a private US company, in terms of a crossover being a bridge and a next step to an IPO. So it's about getting, meeting the company, getting the diligence done, but also being able to support them before an IPO, into an IPO in the US. And not every IPO follows the crossover route. And we talked about alternatives like SPACs and reverse mergers. And I think US IPOs should consult, their advisors about establishing dialogue with a lot of these investors that have been active in pre-IPO rounds. And we are certainly seeing an increase in activity. As we mentioned, it's easier to meet and vet companies ex-US. And similar to the IPO market dynamics, companies are getting funded at an earlier stage. And then, a quick note on deal sizes. We are seeing, I would say in general, larger financings are getting done. But, as it relates to investing in ex-US companies, it really depends on, the company's needs and where the capital will get them in terms of clinical data and other milestones. In this market, the capital is available. And again, we'll see investors overfunding versus underfunding. Okay.
And are you seeing US inflows into any region in particular across the EMEA?
Yeah, I think, it's not in particular. I think it's across the board. Investors are really looking for these undercovered opportunities. A lot of these companies don't have the pleasure of having originated in Boston and San Francisco, so they don't necessarily have access to the same investors from the beginning of their life cycle. So, we and investors are looking to these markets to uncover some of these great technologies that just haven't had the exposure. So I think it's less about specific region and more about the specific companies.
Understood. Okay, great. So the purpose of Edison Open House is the democratization of access to these types of investment opportunities. And at Oppenheimer, you're unique in that you've got a very strong institutional platform, but you also manage over $95 billion in private wealth assets. So could you talk a little bit about how you're able to support your corporate clients in the aftermarket and in accessing these broader groups of capital?
Yeah, absolutely. And first off, I want to thank you again for having me here. And Edison's been a great partner. And I think events like the one you're doing this week really demonstrates the value that you are able to bring to clients. So you mentioned the distribution we have, and we do have $95 billion under administration, our private client division. That's across about 1,000 wealth advisors. And, they've been very active in what we're doing from a deal and non-deal perspective. It's a sophisticated group that really understands the dynamics and drivers around the life sciences industry. And I think that group, paired with a strong global institutional sales platform has really given us differentiated pockets of capital to bring to our clients. And we're really a relationship-driven platform. We're focused on providing tailored, actionable advice, especially in complex and volatile markets like we've seen over the last year. And the team's built a world-class research team, continue to deliver high-value content. So just as an example, we've done a number of conferences, KOL events, fireside chats. We had Dr. Scott Gottlieb present to our clients several times throughout the course of 2020. So that's just an example of some of the value-added events we have. So we plan on continuing to find new and innovative ways to bring value to our clients, and urge the folks on the line here and your clients to reach out to an OPCO rep if you're interested in participating.
Jack, it's been a pleasure having coffee with you. Thank you so much for inviting us into your home.
It's been a pleasure being with you. Thank you, Rachel.
Great, thank you. And if you'd like to get in touch with Jack directly, please email him at jack.terranova@opco.com. Thank you.